Interest rates in a free fall. Unemployment rate reaches its highest point in the last 4 years, going back to October of 2021. And now, what the hell is the Fed supposed to do, given the fact that once again they are a day late and a dollar short? What's going on, y'all? My name is Kevin Weedmark, aka the Mortgage Mouth, and bringing to you a somewhat of a Friday wrap up, just talking about what happened this past weekend. What is the Fed going to do now, and how low actually are interest rates? And lastly, should you lock? Should you ride this wave, or is now the time to pull the trigger? So let's just dive right in. Obviously, yesterday it's all over the news. You can hear it. You can, and any article you pick up. I mean, if I grab this one right here, Fed gets green light for interest rate cuts. Its unemployment rate jumps to a 4-year high. That's right. Once again, like I said, unemployment reached 4.3%. Once again, reaching its highest point that we've seen in the last 4 years, October of 2021. And it looks like now all traders, all signals, take out all the politics, I'm going to fire you from the administration, take all the BS. And once again, it looks like the Fed is a day late and a dollar short to take action. Let's all go all the way back to where we were in about 2020. The Fed was printing money. They printed about 80% of the currency. They kept QE, quantitative easing, in place for way too long. Interest rates were so low. They created the hyperinflation that we saw during the Biden administration. Now, fast forward to today, they've kept these interest rates at the Fed funds rate, at an extremely high level for the past 2.5, 3 years. A lot of people have been saying, look, the labor market's a lagging indicator. I've been saying it over and over and over again. So if the Fed is going to use that as one of their metrics and not look at the overall health of the economy and realize that the only thing that's really just gangbusters is the tech side that is using AI, that seems to be really going well with regards to the market. Everything else seems to be kind of pulling back, and it's been reading that way for quite some time. And they've been looking at that labor number, and now with all these revisions, it's become extremely clear that the Fed is behind the 8 ball once again. So now what they do, because they didn't get inflation down to their 2.7 or their 2% range. We're sitting at 2.7. And if we look at next week, that is going to be the big thing that everyone's going to be looking at through here. Look, on Thursday, we got core CPI, we got CPI year over year, and we got CPI month over month. Those are going to be huge numbers. It's going to give a great indication. I love CPI. The market loves PCE. Not as big of a fan. I think this is a great indication of that inflation number. And let's all hold our breath. We do not want to see the year over year 2.7. We don't need to see that jump. We need the core CPI to come in at forecast, if not lower, and the same for CPI month over month. Otherwise, we are in a big hurt. And given now that the economy is pulling back, the other thing that we have this week, you can see on here, is we get the 10-year note auction and we have the 30-year bond auction. And what that means is if there is no appetite for U.S. debt, and there is a big pullback, the growing concern then becomes, well, Treasury is going to have to do issuance, which means that it's going to create inflation. So now the Fed has a huge problem. They have the problem of inflation that they may have not got under wraps, that, once again, going back to what I said at the onset, they created with printing 80% of the currency and sitting in QE for too long. So Fed Chairman Powell, you did this. You put us in this bucket. We now have sticky inflation. And now it appears that we have a labor market that's really struggling, and an unemployment rate that's the highest that we've seen in 4 years. The good news, however, right? And I say all that and we're like, whoa, that's horrible news. But us in the real estate space, us that are potential buyers for homes, sellers, whatever the case may be, this could be the exact news we've been waiting for quite some time. Because what is going to happen, should inflation remain stable, we are going to see future rate cuts from the Fed. The Fed has 3 more meetings this year. They have a meeting coming up, not next week, but the following week. They have the Fed policy meeting. They're then going to meet in October, and then they're also going to meet in December. So if inflation can remain stable, not increase and actually even pull back, we are going to see at least 3 rate cuts. And we're going to see anywhere from, I would say, 3/4 of a point reduction in that Fed funds rate to 1.25 points. That is all going to be great news for us in the real estate space, for us as homeowners, for us as buyers, for us as sellers. It's going to create an abundance of activity. The one thing that we're going to have to fight, we're going to have to overcome, because look, we can't have it all, right? Is the uncertainty of that labor market. Unless you feel super secure in your job, you may be in quicksand with a want to do something in the real estate space, but it's going to be really hard to pull that trigger. And let's just look at what has happened with the 10-year Treasury. This is the last 5 days in a free fall. We have gone from about 4.3 all the way down to 4.076 is where we closed. Now, is this the lowest rates that we've seen in the last 2 years? Absolutely not. And rates were actually even lower when we had Trump actually come out in April, and it was very brief, of course, indicating what the tariffs were going to be, right? That really created a buzz, and it set interest rates very low. However, we're not there. If we look at just interest rates, here we go from 2020, the 30-year rate is average 6.5 as of September 4th. Now that has changed. I'm going to update what that number is. A year ago at this time, the 30-year rate was at 6.35%. So we were actually a little bit lower than where we were on the 4th, although what I'm going to tell you is we're actually lower than that as we closed business yesterday. But the reason that I bring up this chart is you can see at the beginning here in 2020, this is when the Fed was essentially, in my opinion, and even if you go back further, if we went back to 2019 and 2018, the Fed was doing all that quantitative easing. They were pumping money into the economy. 80% of the dollars were from the Fed printing money. And what it caused is hyperinflation. And then they had to fight it. Then we can see that interest rates were averaging in the 7%, lows, peaks, valleys. I always say lock those valleys, ride those peaks. But we're coming into this nice median right now where since 2022, so for the last 3 years, we've really been riding that 7% with bumps all the way down to 6. And now we're coming into around the 6.5%, 6.25% range. So what does that lead me to? As I just mentioned, interest rates have hit lows as of Friday for this week. Friday was the big day. So if I look at par is where yield spread is essentially zero. And if you don't know what yield spread is, then please don't hesitate to shoot me a DM. Let's jump on a call. Be happy to explain how people in my industry make money. And you should know this, especially even if you're a real estate agent, and especially if you're somebody that's looking to do a refinance or purchase a home. It's how I make money. But if I look at what par, okay, and this is not, I'm not giving interest rates. Everybody's situation is different. So I have to be a disclaimer. This is just information, right? I'm not quoting interest rates here. But if I look at what par rate is, and what that means is essentially where the YSP is essentially zero. Nobody's making money. It is a base rate for interest rates. If I look at a 30-year fixed, you're looking below 6%. Okay, you're looking at anywhere from 5.75 to 5.875. That's fantastic. We haven't seen those numbers in quite some time. You go over into the Govy side, you're in the low fives. And if you're in the jumbo world, so you're over that 806 threshold for a loan amount, you're going to be looking in the low sixes. So this is all fantastic news. And that's why you're going to see over the weekend that you're going to see interest rates that are going to show that they're in the high fives, but you're going to have to pay some points to get that. Or you could take a interest rate in the low sixes and you wouldn't have to pay any points to get that rate. So that's all amazing news. So my last question is going to be, what is the Fed going to do? I think a lot of it depends on these inflation numbers that are coming. If inflation starts to spike, we have a huge problem. We got a major problem, and it's going to be one that the Fed doesn't want to address. It's one that we as an economy don't want to talk about, and we don't want to be in it. It's stagflation, where you have increasing inflation, you have a very high unemployment, and you just get stuck. It's like gridlock, baby. We have to pray Fingers crossed that inflation comes in lower. However, what I do think it's now going to do is the Fed needs to do something. And I think there's division within the Fed. We've been seeing that over the past several months where you're getting a couple of the Fed members basically dissent and say, hey, I think we should have already cut. And hey, they were right. But what you're seeing now is you already have the dissent. And I think what you're going to start to see is more aggressive talk, a very dovish approach. You're going to see potentially, should we get good inflation numbers on Tuesday, I think we could even get a half a point in the September meeting. I think that would be a shock. I think that could potentially push interest rates up a little bit initially because it would be more than the market is anticipating. However, I think that it would be well received in the long haul. And I think by the end of this year, if inflation just remains sticky and doesn't increase, we're going to see a full 1% decrease in that Fed funds rate from where it is today. So that would be fantastic news, y'all. All right. Thank you so much for taking a listen in. Just wanted to give that breaking news of where we are with the rates plummeting and give you kind of the real information, the facts on what is going on to make sure that you're educated and you're not just listening to all the national media or the person that's doing clickbait out there, whatever the case may be. If you want real answers, you want to jump on a Zoom call, go under the hood, take a look, really understand how people in my industry make money, how it affects your interest rate, and how to best position yourself for your financial decisions. I'd love to have a conversation with you. All right, y'all, have a great weekend. You need anything, please don't hesitate to reach out. Make sure you jump over there on YouTube and hit that subscription button. Be greatly appreciated so you never miss a beat. I'm always bringing you great content of what's going on in the marketplace, some a little bit more in depth. And every day on the daily, I bring you an episode of the Daily Dose, very quick 2 minutes to bring you up to speed of what's actually going on. All right, y'all, have a great weekend, and I'll be coming to you Monday. Cheers.